Hello and welcome to this month's episode of Capital Markets View. Hey Taryn, how are you?
I'm okay. Ready to stop socializing with other households now.
Yeah, no, I know. First world problem. Trips to the Cotswolds are now off. But
Yeah,
never mind. We had enough of those over the summer, I
yeah, we did
think.
enjoy the summer, so that's
Yeah, yeah. It's a move from rosé to red. I think it's that kind of season.
okay.
Um, First slide, leverage volumes, and this slide is the whole market, bonds and loans.
Yeah,
And wow, high yield bonds really hitting it out of the park. I mean, like great issuance generally, but great for bonds.
yeah. I think when we looked at the Q3 volumes, they have improved for the loan market, but I think it is good to look at both together because actually high yield bonds, if you look at year to date as well, we're ahead of where we were this time last year for the bond market. So um, it's amazing to look at this and think we just had a crisis.
Yeah,
It,
yeah.
issuance has survived really well, particularly in the bond market.
And actually, you know what? It's interesting the way you phrase that about we've just had a crisis. Of course, I did a panel earlier this week, and we're still in the middle of it. So it will actually be interesting to watch what happens
Mhm.
over the next 3 to 6 months.
Yeah,
So let's and you know what next? So next slide because that's got sponsor issuance on it. And the sponsors, private equity sponsors, are they're not fans of high yield despite a good market.
yeah. I think this is interesting because we did hear at the beginning of the situation that maybe sponsors will be using a lot more high yield debt because it's popular at the moment. The pricing was favorable, and that's a lot because that's driven by the fact that the ECB has continued to stimulate, use monetary stimulus. And so investors are happy to go down the credit curve, buy double Bs. They consider them to be quite safe. So that market looks very good in terms of for issuers. However, we haven't really seen sponsors use it as much as you might have thought. And in some of the bigger LBOs, there have been high yield bridges, so those have happened. But sponsors still prefer the flexibility of the loan market.
And then if you break it down further in our next slide, the double
Mhm.
B high yield bond issuance, which is interesting. So high yield bonds, pretty chunky issuance of double B, which is, as we talked about earlier, not something you see in loan world, but looks quite consistent in bond world.
Yeah, I mean, I think you can see in this chart that actually the double B is very high percentage wise for Q3 2020, but there is kind of an equal mix if you look at the past quarters. So it isn't unusual to see a lot of double Bs in the bond market in Europe as opposed to loan market, like you just said. But again, it's for the reasons that we just discussed. They've been very popular credits with investors, particularly in tougher times, and because of the monetary stimulus.
You know what? I bet you that must mimic what happens in the States because my understanding of the American double B market is it's kind of corporates who are kind of fallen angels, or perhaps people who've IPO'd and are coming up the other way. So they have more of a corporate mindset about issuing bonds, whereas in private equity world, it tends, as we said earlier, to be loans because of their flexibility.
Mm-hmm.
So you've got treasurer sitting at regular corporate. I want to do a bond. Treasurer and private equity person sitting in leverage company. I want flexibility. I might IPO. I might sell to trade. I want to have all kinds of flexibility around my financing, which probably explains why there's more double Bs in bond world.
Yep.
Okay, and then the next slide, which is about companies turning to banks for liquidity. And so you and I have had a bit of a laugh about this slide. I mean, it's a beautiful slide. There's nothing wrong with it, but it's the pro rata there, which for me means bank financing has got a bit bigger. I guess that's the point you're trying to get across here.
Yeah, I mean, it's unusual to see it as big as it is for year to date, but I think I just wanted to also point out that earlier in the crisis we saw RCF drawdowns. We've been tracking that data. Um, Although we are starting to see some repayments of those drawdowns with add-ons, but yeah, I mean, companies and the majority of these companies have been consumer discretionary, making sure that they have cash. But yeah, I mean, it's not a huge trend, but it is a little different than what we would normally see.
I've been doing the rounds of some PE recently, and as a general point, most PE is saying a relatively quiet Q4, but Q1 and Q2 next year will be quite busy. But also, and I don't know, you might have other stats that show this.
Mhm.
I'm getting the impression that a lot of stuff was done either with some with direct lenders and some with clubs of banks, which may be private and discreet. And so they're,
Mhm.
the title of this slide, Companies Turn to Banks for Liquidity, I think that's true, and we're not necessarily seeing it because it's private.
Yeah, I would agree. I would agree.
Okay, and then our next slide about the opportunistic funding and new buyouts slowing a bit.
Yeah, and I think that goes back to what you just said, the fact that private equity has been stalled by the crisis. They've been focusing on their portfolio companies. They haven't been looking as much at new deals. So I think that whole like cycle has been delayed. So we probably won't see, there are deals coming through the pipeline. There are big deals. There's the ASDA deal. There's Unilever's tea business. Like there is activity happening, but
Yeah.
we're probably not going to
Yes.
see the loans for that in the fourth quarter.
Yeah. Yeah. No, you're right. I think it's a quiet run into Christmas and then a busy Q1 and Q2. Okay, and then onto the secondary market with
Mhm.
secondary market prices recovering. I love this slide. It's really great
Thank you,
graphically.
Chris.
No, it's totally cool, and it shows the way the secondary market has recovered. And as you and I talked about, our viewers might not be able to see it, but there is a really itty bitty bit of above par as well.
Yeah, so
Um,
it's less than 1%. It's 0.42% in September, and in August it was 0.24%. So it's just a very small percentage above par, but finally a percentage above par, which we haven't seen since before March.
and that below 90 going right the way down, that 99 to 100 creeping back up, and
Yeah,
the other range, the sort of like 97 to 98. So all of that upper 90s, which is where you expect to see the secondary market.
exactly.
But the next slide about the rolling return on the LE, we're not quite back to normal yet.
No, and that's just because of the market value return going, off not off the chart, but yeah, the very negative return that we saw in March. So that's still, although, we are getting much closer to being positive for the rolling 12 months. So we will probably go back into that territory soon, but yeah, I mean, it's been a long road to recovery.
And then next is pricing. Now, so this is interesting because, I thought pricing had settled, at about 4.25, 4.5. What do you think about pricing? I think for the right sector, it's getting very aggressive again.
Yeah, so I mean, if when you look quarter to quarter, spreads have increased. We've seen a reduction in the OID, so that's on the next
Yep.
slide.
So let's go to the next slide about the
Yeah,
OIDs. Yeah.
so we've seen these are original issue discounts. So we hadn't seen these until after the last crisis. In the loan market, everything was priced at par, but OIDs are now standard. We see discounts now, and that's shrunk, which is why yields have come down. However, I would say, and I keep saying this, I think every month, is that pricing will come down because there is so much demand for the asset class. It's
Yeah.
continued. Investors tell me they're still seeing inflows from existing investors. The CLO market, which we'll get to, has recovered. We're seeing a lot more issuance there. So pricing will go back down. We will return to unless the supply and demand dynamics change the way they're looking now, there is quite a lot of demand.
And on the other side of that equation, again, I'm hearing for private equity, for the right companies, bidding is furious,
Mm.
for the right companies in the right sectors. Okay, so and then right, so the next slide is total leverage. Now, Now, I think we have slightly different views of this.
No, and I do want to caveat this with saying, and I think I've said this before, there are not a lot of newly structured leverage buyouts in this data yet. It does look very high. It's higher than it's been since 2007, and I know, obviously we're not trying to be, sort of shout this from the rooftops. I did want to just point it out because if we go to the next slide, you can see that when we look at the measure of spread per leverage, you can actually see that investors are being compensated for this risk. And a couple of other points, we don't have a lot of near-term maturities, and I will publish our interest coverage ratios as well because those have been improving. So, we have a very low interest rate environment. There are not a lot of maturities coming due. So yes, leverage is high, but there are these mitigants, and private and equity checks are still high. They've been high for a while. So yeah, are you
Yeah, I
caveating it?
mean, I was going to, you and I will slightly disagree on the leverage here because for me, I mean, yes, it's higher than it was, but I see that graph as my view is it's relatively flat. I don't think personally this crisis has led to masses of more leverage being put on deals. I think it's relatively stable. And again, talking to a PE firm the other day, he was saying to me, I remember the days pre GFC where it was 70% levered and now we're at 50. The equity check is below. Sorry, the leverage is a lot. The cash is lower. There's more equity going in, and that's still true. Okay, and then let's flip to CLO coupons, and again, love this graph, new form of graph. I only noticed this a few weeks ago in the CLO Weekly with the dots which shows very clearly points where CLOs are pricing and how it's come right back in. Slight uptick, I think, might happen in CLO pricing because the market's got a little bit of indigestion.
Mm-hmm.
But wow, way back in, which means the arbitrage is people disagree on whether they think it's good or bad. I personally think it's reasonably good at the moment, although the lower bits of the stack are a bit pricey. But yeah, it's looking good.
Yeah.
And then if we look at the next slide about reinvestment periods, with 3-year reinvestment periods, so structures in CLOs are, not far away from where they were pre-crisis. 3-year reinvestment period, 4-year reinvestment period. It's pretty good. If I think the key, as we've said before, is getting hold of the assets. That's
Yes.
key for CLOs, and there's not enough for them out there.
Yeah, and the fact that secondary market prices have improved so much, so they can't use as much of the secondary assets to increase that spread. So yeah, they want more assets, and that's what I was talking about before with the supply demand,
Yeah.
and why we think pricing might continue to decline, or continue to start to decline spread wise.
And it will be really interesting next month and the month after to see that kind of 99 to 100 bit of the secondary
Mhm.
pricing, and then to see if it really does grow above par, because we got another ratings mandate in this morning, and I had
Mhm.
one in last night. So I mean, and I know that's the rush before the presidential election, but
Yeah.
there's a lot of CLOs out there and new warehouses being open.
Yes, exactly.
And then our last slide is it's Halloween, or Halloween coming up.
Yeah.
So happy Halloween. I know Cato's probably a bit too young to. I mean, well, there's no trick or treating at the moment, but hopefully
No, we'll just have to dress them up in some ridiculous outfit to send to the nursery, and
put him on Instagram. And I love pumpkin pie. Wow, make
mm,
some pumpkin pie. Thank you very much, Taryn. Thank you to everybody who watches. Don't forget, this is now something you don't need to register for. So please share amongst your colleagues. There will also be some quite interesting research attached to this. I should have said at the beginning, we've just produced a new CLO piece of research which we'll be attaching to this. So as ever, if you have any questions, feel free to contact me and Taryn. And happy Halloween. Thank you.